That's what happens when I start telling stories before I get up to the podium. But good afternoon, ladies and gentlemen, and it's good to be back again. As Kevin had said, I'd been attending here since 1975, and it's an honor and a privilege to be here to speak to you today. I wanted to start by giving a bit of a high-level overview. I feel it's a good idea to start with a global view before you move into more of the local impact on what's going around us these days. So I'll start with external factors, major grains, sovereign debt in the EU, other factors such as the foreign exchange, the impact on the Canadian-US dollar, some of the minor currencies in a lot of the countries that we trade with, weather, and also touch at the end on the lentil supply disposition chart. Major grains are right now in a retreat mode, and heavy supplies of wheat amid strong export competition, including grain from out of Argentina and Australia, mostly reduced the FOB values between $20 to $30 a ton over the last month. Wheat prices, though, are still relatively high historically. Durum wheat is a major crop in our area, around the Woosh area and Swift Current areas, is trending down, but still a decent value for new crop. I'm hearing around $7 a bushel. There's a bearish sentiment on the canola market because of the prices are high now and are attracting growers to plant more acres. It could be as high as 20 or 21, 22 million acres, I suppose, but that will be determined. And I think what Brian was alluding to with his colorful chart there is that we tend as farmers to chase the falling star. Prices for new crop wheat, durum, and canola still provide a good return and will be a competitive factor against pulses. So just to throw up a couple of charts for you, I threw up the corn chart. You can see from the left going to the right that it's rolling over, and this was a snapshot taken in December, and it has had some further declines. I've also threw a wheat chart up there, much the same thing. You can see how it's trending down, and then finally soybeans, which does have an impact on the oil seeds, namely canola, and it's heading down also. On the European debt crisis, I posed the question, and everybody's been asked this: can we build a firewall around the EU crisis? I would say that some of that fire has escaped, and namely in the area of the EU economy is likely in a recession, and I think the impact will be that the US and the UK have a 50-50 chance of also falling in a recession. One of the key things to keep in mind, too, is that Canadian and U.S. banks do have exposure to this debt crisis, and that could have an impact on our availability of credit. I grabbed this graphic because I thought it was a pretty good, I know you can't really read it from where you're positioned, but this is a chart showing the infamous PIGS, they call them: Portugal, Italy, Ireland, Greece, and Spain. And the highlight here is the debt that these countries have to other countries such as Britain, France, and Germany. Greece holds about $230 billion in debt to these countries. Italy, $1.4 trillion to Germany, France, and Italy. But then if you look at the the arrows that go across back and forth, I'll just grab a pointer here, but you can see how these thicker lines here show larger amounts of debt between one country and another. So in this case here, you're seeing 46 billion of Italian debt owed to Ireland, and also Italy back over here. You can see owes France $511 billion, which is nearly 20% of the French gross domestic product. I just thought it was a really good graphic that tries to put it all together to see just how serious this debt crisis is. The impact that this has had is on currencies has been people losing confidence in the EU and other emerging markets. So we're seeing a strengthening of the U.S. dollar. The Canadian dollar has also been holding its own because of we're resource rich and not as bad in debt. But the forecast for Q1 for the CAD is to be parity, which would be around 1 to 105. And the forecast of the CAD by the end of the year, it will be near par. Minor currencies, on the other hand, have been devaluating. So countries like India, who uses the rupee, the peso, which is used in Mexico and South America, have all been declining. Iran, that uses the rial, just in November to now has dropped nearly 25% in value. And also the currencies in Algeria have been declining also. Money is flowing out of these countries because they perceive there is less risk in the U.S. So this outflow is causing major devaluation. And I've decided to throw up a chart here because India is probably about as good an example as any. And so I just took this snapshot off of a foreign exchange chart, and you can see the rupee down here to the U.S. dollar in early August was around 44 rupees per U.S. dollar, and you can see the weakening of that currency to around 54. Again, this is old data. It was, this snapshot was on the 3rd of January. The other factor that you have to look at is weather, and in all the lentil-producing countries in the last year have been pretty favorable. And when you have high prices and then a combination of decent weather, you see that the supply of lentils has improved overall. The Australian harvest, which was in November and December, was a good crop, but they have very little storage. And as a result, they ended up having a glut of lentils in Australia. Nearly 60,000 metric tons of old crop was being carried over, and at the same time, new crop pressure came along, and they had nowhere else to go but to lower prices to attract buyers. And so that's what caused a further decline in November, December in the red lentil market in particular. India's, on the other hand, weather has been not as favorable, with a slight decline in the kharif crop of about 5%. And I missed putting a number in there. I was researching the rabi crop, but what I found is quite a bit of controversy between what's being reported officially at 1.5% to where a lot of private traders are reporting as much as a 40% decline in the rabi harvest. So that is a positive note in terms of potential reduction in red lentils. And then, of course, our own weather here at home, which is something we're all watching closely. Somebody said last week, I don't know if it's true, but they say they're golfing now in Medicine Hat. And some have been joking about possibly starting seeding up here pretty quick. But here's a chart for our subsoil moisture map. This is a snapshot taken from the Saskatchewan Agriculture and Food website on November 1st moisture conditions. And you can see a real differential between the southeast corner that was largely flooded up till June, and then the west side of the province that has been drying out. So all eyes will be on the west half as we see the potential here for this west side, west central area is really important for layered lentil production. So let's keep an eye on that for green lentil producers. And in the southeast, we tend to see a lot of smaller seeded crops like Estons and red lentils in that area. So we'll be seeing how things go well in that area. So time will tell, and we'll have to watch what the forecasters have to say. So far, they've been wrong. They thought that by now winter would have returned to Saskatchewan, and that has not been the case. So we'll just drill in a little bit onto the red lentil market. We did have the hangover of the 2010 crop, which is of poor quality. There's literally boatloads of stock in Mersin and Navashiva, which has been impacted by surplus inventory, visible stock. One thing that's important to note about the Mersin market is that they're typically used to seeing truckloads of lentils being purchased domestically from Mersin growers, Turkish growers. So if there was more demand, they would raise the price slightly in lira, I suppose, and then they'd draw in more truckloads, and they kept a fairly good balance. If there was a need for supplemental supply, they typically in the past would buy container loads of whole red Canadian lentils to meet their milling needs. But in the last couple of years, we've seen 2 years ago nearly 170,000 metric tons of lentils go into Turkey, largely red, and these are also largely unprocessed. And in 2010, so far, nearly 110,000 metric tons. As a processor and being involved in this industry for nearly 33 years, I am concerned. And I come from a processor background, so I definitely have felt that we were an important link in the development of the industry in trying to put our best quality forward. And it does, I think, cause Canada to be at risk when we start to ship lentils unprocessed. And one thing that for sure that we need to keep our minds on is what could be in that foreign material, something that could upset the phytosanitary situation or regulations in other countries. So we're at a crossroads, and at the beginning of 2012 with a new board, I think it's really important that they stop and re-envision and recalibrate just what they want to do with this industry, and you as growers would need to give voice to that also. But we did experience a big setback last year in the glyphosate issue in Europe, and we saw the impact that had on our ability to access that market. And I certainly wouldn't want to see access to these markets hindered because of something in the foreign material that could injure our reputation. Recently, we did have in November a shipment of red lentils, a couple of containers. I'm not sure exactly the size, but it has been reported that they were rejected by India. So even though you have a price-sensitive market, they still want quality. And so I'm not sure what the details are, but it does show how we need to be mindful of the quality that we put into these markets. I do think that if current bids for red lentils persist, I think we'll be looking at a major contraction in the red lentil production area. And I also think that with that global reduction in red lentils, because I think Turkish farmers and Australian and American farmers have also reduced their red lentil production. And as a result, I do think there will be some stabilization in our price, which today is a bid around 16, 17 cents a pound. And hopefully we've seen some stability in 6 to 12 months and see some improvement in his bids in the next few months. Time will tell. On green lentils, we have had excellent quality in 2011, which is much needed because that is what our buyers are expecting from Canada, is a good number one or good number two, without wrinkling and without staining. And so with that, we had the majority of our demand in Iran was filled rapidly. It's about a 40,000 metric ton market, and within 3 or 4 months, that market was basically filled. We also today we are experiencing a combination of seasonality in layered lentil demand. It's not unusual for us to come into the pre-Christmas period. I call it the Christmas doldrums, where the northern hemisphere demand has been largely filled off of the harvest time, and we have a slowdown before Christmas. But then we typically will see, now we're into the new year and heading in towards spring, an increase in demand for the large green layered type lentil. Another major buyer, specifically for number 2 lentils, is Algeria. They too have been fully supplied, and also having to deal with the prices dropping and trying to manage their cash flows. Just to give you an idea, markets from the fall are down at least $200 to $250 per ton. And what we're finding is because they have fewer dollars to be able to buy the arriving cargo, they're now needing more of their local currency to be able to clear these stocks. And the only way that they can find cash flow is to take their current inventory and discount it significantly in order to give them more cash to go back and clear more stocks off the dock. And so this is the problem that they have, is not only the supply problem, but their weakening currency and lack of cash. And I think that this is not just a problem with lentils. I think this is across a lot of commodities that are arriving at these ports these days. In another commodity that usually we look at to try to help underpin our number 2 lentil market is the value for pigeon peas in India. Pigeon peas can be substituted with a number 2 layered or an extra 3 layered. But today, with the low prices of pigeon peas, there's really no opportunity right now, unless there's an improvement in pigeon pea prices, for us to gain support from India. And so I think that the demand for the remainder of the year will be steady, but I think that that'll still mean there's going to be a sizable carryover. Current bids are under pressure as a result of all these things we've been mentioning, and so I expect some reduction in the layered acreage unless there's a late spring rally. Again, going back to the weather issue, if things get really bad here, we could see maybe a slight, maybe not the reduction that I'm forecasting. Expect also more competition from Russia. We did encounter some 8,000 metric tons of good quality production out of Russia this year in the large layered caliber, and very competitively priced. They have a geographic advantage. It's, I think, a couple days by truck to deliver from Russia into the Mersin market. So this has been a challenge for us in terms of seeing more competition from other producers around the globe. Small green lentils, we didn't have a big carryover, so really we didn't have any burdensome inventory, but what we did carry over was number 2s, and those have been a little bit tough to sell. But because of the really good quality this year, and there's hardly any number 2s from the 2011 crop, we have been slowly been able to get rid of any old crop inventory from 2010. So right now I think that there's some sympathetic move, though, with green lentils and other commodities overall because of these currency issues and things mentioned earlier. But I don't think there will be any significant carryover. So I think there's room for increased production in 2012. Just touch a little bit on some of the niche lentil markets. The CDCI Barina Spanish brown lentil, which we have exclusive release for. It's a small market. That's why it's been released under tender. We've been working hard for several years to try to convince our Spanish buyers that our version of a Spanish brown will be a good replacement. And we're having some success with that. And so we're hoping that in this next year to try to capture 5,000 metric tons of this 20,000 metric ton market. We compete directly with American and local production in Spain. So the current price is around 32 cents a pound, and new crop price would be, I expect, somewhere around 30 cents per pound. French green lentils in Canada, there's very limited supplies around, and so we are thinking there's room for increased deliveries or production of French green. I think current bids around 45 to 48 cents per pound. So medium green lentils too, we do want to encourage medium green or richly typed lentils because they are, we do have good Canadian demand for Canadian lentils. So I'm down to my last minute and last slide, and This is my chart. I probably was a little bit more aggressive in the reduction in production areas of red lentils than maybe Brian was in his forecast. But what we're seeing overall is a decline in production. I penciled in a slight increase in the small green lentils from 200 to 225,000 acres. These are all based on normal yields. Like Brian said, I think a lot of our 2010 crop reds that we thought could mill aren't milling and aren't acceptable. So I see a lot of feed going out of the 2010 crop number 3s. And so I see a carryover of around 345,000 metric ton, or a stock use ratio of 24.2. So I wish I was a bearer of better news, but as Albert Einstein said, in the middle of difficulty lies opportunity. So thank you very much.